It's been a crazy week for investors, and just when the US market was falling into official bear market territory, Friday saw a massive turnaround in the last few minutes. It's a confusing time for investors who have seen their stocks take a pummeling over the last few weeks, whilst they have to contend with world events, the threat of inflation and rising living costs. The post-COVID market has been a non-stop rally for the last 2 years, and looking at the chart, it's clear the market has become too heated and a correction was likely, anywhere from 15 to 45%. But the problem that I see is where investors, particularly retail investors, stuck at home with their COVID cash on hand, piling into overly optimistic, toxic stocks, loss-making companies trading on sentiment, SPACs, Bitcoin, NFTs, driving an inflated rally that was bound to have consequences. There's a concept that I've wanted to upload for about a year now, but I've held back as I didn't want to offend my audience.
Emotional, damn it!
But at this point, I think the benefits outweigh the cons. This is a concept I like to call idiot stocks. Here we go. The stock market used to be solely for competent professional investors who had to pass exams that represented a level of education and qualification to trade on the stock market, where they could amass great quantities of wealth for their investors. This continues to have a large benefit to the upper class with plenty of excess income to invest. The top 1%, the owners of large cap companies who could amass millions, billions to spend on trips to space, whilst their working class employees laboured on their behalf, working low paid hours and peeing into bottles because they are penalised for taking toilet breaks. And this working class, who suffer the most just to have something left over to put into their savings accounts, to be rewarded with pitiful interest rates, far below stock market returns and lower than inflation, meaning they effectively become poorer by saving money. Whilst the cost of living continues to trend upwards, and the advice I'm hearing from politicians is to buy budget goods, get a better paying job, work longer hours.
What, are you kidding me?
You're kidding me.
Kidding me?
You gotta be kidding me!
Or maybe we should just hold out and hope that Drake is willing to pay for our groceries. The introduction of retail trading apps created an almost level playing field, opening the door for any class of people who could invest whatever little income they had, and even if they don't become millionaires or billionaires overnight, they could at least grow their savings at a rate that makes them financially better off. But with great opportunity
comes great responsibility.
Anyone can set up an account and start trading within minutes, without any significant checks on their credentials or experience. Investors with ambitions greater than an investor knowledge risk throwing their money away by chasing advice from bad influences, relying on social media sources instead of proper research or understanding of the market. In the US, investors can lose fortunes by betting on options which typically have volatility already priced in, whilst in the UK we have CFDs, which are essentially gambling against the market, and that's why the current figures state that 76% of CFD investors lose money. That's where I have a label for this type of ignorance: the idiot investor. Imagine the most famed influential investors, hedge fund managers, and their various investment strategies, evaluation techniques, and their experience. You may not agree with all of them, but you have to respect that they develop their strategies based on years of experience. But then we have our idiot, who lacks any invested knowledge or experience, let alone any strategies or analytical tools, no wisdom to come even close to matching the rest. The idiot investor doesn't know how to find investment opportunities, and they certainly aren't going to identify any smart money or institutional investments. They trade on superficial insight, using their app to go along with whatever concept is trending on TV, online, or social media. The most obvious media attention grabbing companies so well known to the public that you would have to be an even bigger idiot not to have heard of them. Last year, Jim Cramer made a point of grouping together some of the media highlighted companies under his various acronyms to help investors remember them. FANG grabbed the headlines for years, then he came up with watch stocks, and the latest involved Microsoft, Facebook's change of Meta, and Google's parent company Alphabet to give us mama stocks. It's catchy, but I think if we add a few more companies, and we move this over here, and that over here, I think we have Now, I'm not having a dig at Jim Cramer, and I have a lot of respect for what he does for investors. And if you follow Mad Money like I do, I guarantee you will learn things that will help you with investing. But the use of acronyms to simplify the market down to the biggest and most media-influenced companies is setting a trap up for investors who don't know how to be critical of the companies or this approach.
Shut up and take my money!
When the media focuses on a small group of successful companies, their stock growth becomes a self-fulfilling prophecy. It creates a rally based on sentiment that can drive the stocks up well beyond their intrinsic value. Companies and hedge fund managers have caught on to this, and they know that they can use TV shows, adverts, Facebook, Twitter, Reddit, any social media attention to pull in idiot investors who are too willing to pile in on the trend.
Oh, so it's a hustle.
Yeah, it's awesome.
Why didn't you say that, man? Father, everybody. It's a hustle. To the moon.
And when there is a rally, their boards are happy to sell additional shares and generate more capital for the company, inflating the company value whilst insiders sell out on a massive profit before the stock crashes. The irony is that when these companies are driven up by media attention, it can be their undoing when the company or the representatives get into trouble and the world is watching. Cathie Wood had no problem using the media to brag about her successful Tesla position whilst it was on a high.
Tesla. I think it's incredibly undervalued.
But even a broken clock is right twice a day, and as Tesla and the majority of her largest ARK innovation positions continue to see tumbling stock prices, she has the audacity to expect investors to wait 5 years.
And if you were to give us that 5-year investment time horizon...
Consider the stocks that received the greatest level of media attention for the last 2 years. Tesla, Amazon, Facebook, Nvidia, ARK, Apple. They climbed to epic peaks, trading at the highest fundamentals, only now it's their downfall that is leading the market into bear territory. And many of the investors who bought into the positive momentum are taking a beating. And many are going to be quite pissed off for looking like idiots. This is not to say that they aren't good companies, in fact many of them are, but there is a basic level of due diligence that goes into stock selection, critical analysis that helps smart investors make smart investments, and recognise when stocks have been overbought. Ignoring those steps in favour of positive media coverage is an idiotic method of investing, so when those stocks continue to rally regardless, they become idiot stocks, and smart investors need to avoid them. When the market behaves this way, it becomes harder to imagine how it's supposed to work, or how the best investors made their fortunes and reputations based on research and good decision making, not idiocy. Let's talk about Warren Buffett, who has the reputation of being one of the greatest investors of all time. He started buying Coca-Cola in 1988 when it was hit hard by the 1987 market crash, for around $2.45 a share. At the time, he was determined that it was a well-run company, had good value and a business model that could beat the competition and recover from the crash. As Coca-Cola grew into a more capable business, developed massive distributor networks and retail relationships, absorbed competitors, negotiated better deals, lowered their cost margins, expanded into new markets and trends, and became the globally recognized empire that it is today. At the $60 mark, it's grown over 34% in the last 5 years and trades around 25 times earnings with a $264 billion market cap. As of Q1 this year, it's Berkshire Hathaway's fourth largest holding, representing around 7.5%, over $24 billion, and represents a return of around 2,477%. And the 2.7% dividend yield in 2021 gave Berkshire Hathaway $672 million back in cash. Buffett didn't buy Coca-Cola because of media coverage. His strategy has always been to find undervalued companies, invest big and early from the ground floor and hold for a long time. If he had waited until the market recovered, until Coca-Cola had fully recovered, he would have missed out. In fact, by the end of 1989, the stock was trading for over $5, double what Buffett paid, so that delay would literally have cost him millions. Peter Lynch is another example. The former Fidelity Magellan fund manager was a bottom-up investor who made a point of looking for good companies selling under the radar at bargain prices, as smaller cap companies, those outside the S&P 500 for example, had the potential to outperform larger caps. If you think about it, every company starts out as a small cap, and when they turn into the likes of Amazon, Tesla, it's the original investors who bought in at the ground floor who benefit the most. Lynch said that too many see investing as gambling when they should instead be focused on fundamental research to identify strong companies with attractive growth prospects. Otherwise, they should keep their money in the bank. His recommendation was that investors need to understand a business and their prospects, their strengths, weaknesses, threats, essentially a SWOT analysis. With proper research, economics or market forecasts barely matter. He even stated that if you spend more than 13 minutes analysing economic and market forecasts, you've wasted 10 minutes. He said investors should review the company every few months, checking if anything had changed, if the company still matched with the reason they bought in the first place. If the company remained on track, maintained their fundamental value, and the stock fell for some reason, then this presents an opportunity to buy at a genuine discount, presenting even larger gains in the future. He spoke of rotation, selling out played out stocks in favour of similar stocks, the same industry for example, with better growth prospects. The focus was always to remain committed to the stock market, but focused on relative fundamental values. So the challenge of smart investing is being able to find companies with good fundamentals at a time where they're undervalued and present the greatest growth prospects. So when investors are distracted by idiot stocks, they're missing out on finding good companies early on, companies found by good research and offering great growth and are less likely to see a correction. That doesn't mean we should ignore idiot stocks, as the accumulation of massive market sentiment can offer some guidance on what investors should be researching. They are bellwether stocks. A bellwether is when a farmer places a bell around the neck of a ram that leads a flock of sheep. The ringing of the bell indicates where the flock is. Bellwether stocks are the accumulation of massive public opinion and indicates where market growth is being influenced.
Now we know.
And knowing is half the battle.
So rather than buy into overpriced idiot stocks, it's better to research the same industries to find their competitors that may be trading at more reasonable valuations with better growth prospects. Additionally, that research provides a better understanding of the industry and what to look for. So when the media is pushing a company, not only can you say no thank you, but when you do eventually come across a company that offers a great investment opportunity, you'll be able to recognize it. No idiot stocks for you. The concept of idiot stocks is not to offend or belittle investors. It's a label used to quickly identify stocks which have been pumped up by market momentum, rallies created by the media, CEOs or hedge fund managers. Buying into overbought companies when their fundamentals deserve to be criticised is idiotic. Smart investors learn from the strategies of the most successful investors. They do the work. They look under the radar for the most undervalued companies before the media gets hold of them, before most of the growth is priced in. A bear market is going to act as a much needed reset, an opportunity to rein in the most inflated companies and redistribute some wealth into better valued investments. As much as the media is likely to focus on the Goliaths, Apple, Google, Meta, etc., as trading at a discount, those companies have had their day in the sun. Their fundamentals weren't strong enough for their positions and the market has judged them accordingly. Even if investor sentiment does drive their prices up again, I don't see them any more than a trading opportunity, and I've traded them to death. This is an opportunity to look among the devastation for better valued companies with solid fundamentals backed up by profits, growth and a decent dividend. Although it sucks when these stocks may not get the same media attention as Tesla, it won't suck as bad as a portfolio full of idiot stocks during another market correction. So that's my take, and if you have any thoughts, please comment below, let me know. And if you like what you see and you want to see more, remember to smash that like button and subscribe so you don't miss out on future videos. Until next time.